Hello everyone, welcome to Global Online. Let me check, am I audible to all of you or the screen is completely visible or not? Let me check once so we can further. After I check, I will start our today's session. Hello everyone, welcome to Global Online. The screen is completely visible. Okay, voice is okay and screen is also visible to all of you. So let's start. So a very good evening to all of you, the students who are preparing for the UGCNET June 2025 preparation, especially for the commerce and management subject. So here we are running our Maha marathon session and this is our day 12. Okay student, so here we are going to discuss the top most 50 most expected MCQs that will help you for your preparation. And so let's start with the begin with the first question. First question which is in your screen. So first question is the matching the pair. Okay, and this question is from the unit economics. Okay, so in the economics the list one is given, that is perfect competition. Actually this is competition perfect is not like this, it's a perfect competition. Okay, so it is a perfect competition. And then second one pure monopoly, third one monopolistic competition and oligopoly. Due to throat infection I know that my voice is maybe clear to you. Okay, and I'm trying my best that you will understand my words and what I will explain you. Okay, uh, so let's start. And in list number 2 there is how do you connect with list number 1. Okay, so as you know that in the perfect competition, actually this is perfect competition. Okay, so perfect competition, you know, in the perfect competition products are homogeneous. Okay, and they're homogeneous substitute for each other. There is a feature that in the perfect competition the products are identical product, that means they are the same. Okay, and where there is a perfect competition, so here you can easily match the perfect competition with the homogeneous. So a you match with the second one, so here match the A with the second one, match the A with second one, so your option number B and option number D will be going to be cancelled. Okay, then in the pure monopoly, you know that what are the features of pure monopoly. There is a reference to where there is the single seller in the market. Okay, here is a single seller. Okay, single seller, and there is no closely substitutes available, and that's this no closely substitute available, this indicate that your price rigidity. Okay, no close substitute goods. Okay, substitutes, so this is known as price rigidity, so you can match with the third one. So here we will get option number C will be the right. Okay, in the monopolistic competition, you know that it's involved the product differentiation. Okay, so where the a firm sells similar but not identical product, like mobiles, they are both mobiles are same, they're using for calling, WhatsApp and other social media and other form, but still there isn't a variety. Okay, they is a small difference make the product differentiation, so that's why this is a product differentiation. Then in oligopoly there is a substitute, no actually no substitute. Okay, no substitute, so you can match with the D with the 1. So here will right answer will be option number C will be the right answer for this question. Okay, I know my voice is harsh, but still I am hoping that due to throat infection this has happened. Okay students, so I am here with a complete course of commerce and management. for those students who are preparing for the UGCNET June 2025 preparation, our new batch will be started from the 12th of May. So this is also golden opportunity, and this is the right time you have to join your session, join your class, and this will be help you for your preparation. And if you register yourself for the paper 2 either commerce for or management in the 8,000 rupees, you are not only getting the paper 1, you also get the paper 2 also. Okay, so paper 1 plus paper 2, this is a complete package. So if you register, so what you will get over here, daily live session, daily recorded lectures is available. Okay, live session, if you fail to see the recorded session, so you can see the recorded session. Okay, complete syllabus notes in PDF format is available. 100% syllabus is going to be covered over here. Okay, I will cover 100% syllabus along with the revision. And then yes, this is a question, how do you do that, ma'am? So I cover 100% syllabus with your revision, and this revision I will take with the analysis of PYQs. I will make most expected MCQs which you have seen in your last question paper. Okay, so this is on the basis of this we take a revision, and full mock test is available, 4000 MCQ series, PYQs with detailed explanation. And if you have any query along with that, so WhatsApp contact number is given to you. You can get in touch with this WhatsApp contact number. To join the global online, you have to download the global online app, then you have to register with your mobile number, then you have to go to my course section and register with the whatever course you want, either for the commerce or the management. Okay, and after that, once you register, you will get unit wise folder over here. So in this unit wise folder, you will get all the detailed notes, detailed PDF notes, detail the mock test. Okay, then along with the PYQs with explanation. Okay, and we also add you in a WhatsApp group. So in the WhatsApp group, we also send you a PDF notes. So this will help you for your preparation. Okay, this is for the paper 1, this is for the paper 2 also. Okay, so moving toward the next question, that is this question also from the economic portion. Okay, so first statement, that is perfect competition is a myth, monopolistic competition is a fact of life. So isn't it a true statement or a false statement? So yes, according to the few features which is given, which justify, which tell us about the perfect competition, we actually haven't seen this kind of competition in real life, which is paid by the company is higher, and insurance is higher. This is high fixed cost. Okay, but have a stable and predictable revenue. I know that when I started my business, the rent I have paying for that particular shop is 2 lakh rupees. But I also know that the revenue which I get from that uh, business is 4 lakh rupees. So I know that my fixed predictable revenue will be 2 lakh rupees. So this is stable and predictable revenue is 2 lakh rupees. Which of the company following statement should be true about this company? So what is actually shown? Okay, so first and most important thing that you have to understand about this question is that companies with high fixed cost but they have a stable and predictable revenue, it means that they have low business. This is most important point. It means that the meaning of this statement is that the business having the low business risk, because here the company know that the revenue is consistent, the revenue is constant, actually make it easier to cover their fixed cost, and they predict the future earning. So this stability reduce the company's uncertainty, isn't it? Uncertainty in their operation and making their overall business risks lower. Understand? So fixed cost is higher, but Still the company having the stable and predictable revenue, it means that company is having no business risk, or either there is a low risk business risk. Okay, now I'm reading one option and I will explain each and every options to you, so that will help you to understand what will be the right for this question. Okay. Okay, student. So first thing, the degree of operating leverage is relatively low. Now, first of all, whenever I am talking about the operating leverage, okay, so in the this is, it means that the degree of operating leverage is relatively low. So if my operating leverage is low, it means that company facing some business risks. Operating leverage play a very important role, because company with a high fixed cost tend to high, their operating leverage will be high, because this has happened because of high fixed cost. This is not possible if company's fixed cost is high and their operating leverage will be low. It's not possible. If the company's fixed cost is high, so the operating leverage behind for that particular firm will be higher, and it meaning a small change in revenue. If you change a very small change, that means if your revenue goes down, what, suppose the revenue is 3 lakh, you make a small changes, so revenue can lead to significant change in profit, isn't it? So your profit is goes down with a 1 lakh rupees. So this is happen. So that's why this is not a correct statement, because they use a word low. If we use instead of this low, if we use if I was used high, then it will be correct. Okay. Then the second statement, their bond issue would tend to have a speculative rating. Now it is not necessarily true, because stability in revenue, especially they mention that stability and predictable revenue, stability in revenue might indicate that lower the risk to the investor. If your revenue is stable, that means every month you are getting 2 lakh rupees, that means your revenue is fixed. So it's, it means that it indicates that there is a lower risk to the investor, isn't it? Because they know that if I invest in that particular year, there is a fixed revenue, that means they assume that there is a low risk. Okay, and this has happened. So it leads to a non speculation. This is not a speculation, actually this is non speculating rating, because there is a no chance of speculation, because they know that there is a cost will be stable, the revenue will be stable, so there is a no speculation also over there, isn't it? So this statement is also wrong, and as long as the company can reliably cover this fixed cost, because the revenue is stable, isn't it? Now the option number, this is also incorrect. Now see, their overall business risk is relative. So yes, this is true. Yes, this is true, because you know that if the fixed cost is higher and your stable and predictable revenue is if the particular firm is getting, so it means it's clearly you can see that the overall business risk will be relatively low. Okay, there is a certainty in business, so this is correct. Okay, then they are unable to take on much additional financial risk. Actually this is not true, because the ability to take an additional financial risk, this is depends depends on what, it depends on capital structure, understand, this is depend on capital structure and the nature of their revenue. okay, not just on their high fixed cost. Okay, it's not just on their high fixed cost. So whenever they this is say that there is enough additional financial risks, but this additional financial risk, it's not depend on fixed cost, it's depend on what kind of capital structure is followed by the company. Some company take a extra debts, they are not interested to get or to collect his revenue sorry finance from the equity, and some of the company they give the importance to the both. They collect their financial fund from the debt and equity. Some of the give, they are not believe in debts, they give the importance to the equity. So actually this is all happen, it's based on capital structure, not on the fixed cost. Okay, so that's why option number D will be the right answer over here, sorry, C will be the right answer. Okay, understand, this is most important question. Okay, because here you cover all the basic concept of about the fixed cost, basic concept about the financial risks, basic concept about the operating leverage. Okay, that is. Then moving toward the next question, this is numerical question from the business finance, financial management. Okay, let's start with the actually this question from the return on invest equity. Okay, now there is some X company has targeted return on equity is 14%. Okay, the financial leverage of the company is 0.5. The corporate rate tax applicable to the company is 30%. If the average cost of debt is 9.5%, the ROI, return on investment, that company should earn to achieve the target ROE is. Now, first of all, to calculate the ROE, we require to calculate return on investment. Okay, so this is what here, to target this return on equity, we need to calculate a return on investment. So what is the formula? So formula for the ROE will be return on investment plus return on investment minus R, then dividend divided with equity, and then you have to then this is R. Okay, then E, then first minus T. Okay, this is now here return on equity is 14%. Return on equity is 14% is given. Okay, then return on investment, what we need to find out, we need to find out ROI, return on investment. Okay, now R, the cost of debt is 9.5%. This, the cost of debt is 9.5%. Okay, then the debt or equity, that is your financial leverage. Okay, so this is debt divided with equity, it is your financial, so 9.5%. Okay, that means you have either you is 0.5, sorry, 0.5%. then corporate tax is 30%. This is okay, so you have to try to calculate this question. Okay, then I will explain you what will be the how do you solve this. Okay, this is your homework, you have to solve this question at your home, and then the next session I will tell you how do you solve this. Okay, I will tell you what will be the right answer. Right answer will be 16.5%. Okay, so formula I have given to you, just put that amount in that, and then you have to this will be the formula. Okay, and then you have to answer it, isn't it? So right answer will be 16.5. Okay, then the next one, the next question, list number 1, list number 2, operating income, capital employed, inventory turnover, then gross cash flow, and you have to match with the list number 2. Okay, now first of all, what is about the operating income? What do you mean by the operating income? Operating income, the kind of income which is used by the company before before interest and taxes. This is your operating income, is nothing but your EBIT, earning before interest and tax. Okay, so you operating income you can match with the E, profit before interest and tax, EBIT. So you can match A with the fifth one. So A with the fifth one, that option number D will be the right answer. Most of the matching the pairs are very easiest to score. Okay, now because once I sorry okay, then we have capital employed. Now what is the capital employed? Capital employed, it means that how much capital company use for their production, for their employment, that is the capital employed. So actually capital employed, the company has to calculate with the help of whatever the company's total asset. From that asset, company reduce his current liability. Okay, then company reduce his liability. It is what actually company, how much capital is using for their production process. So that is the capital employed, how much capitals the company has employed for their in their production process, for the development of the organization. Okay, so you can easily match this capital employed. It's what, this is not next, this is net fixed asset, investment and net working capital. Okay, this is what your capital employed. Sorry. Okay, this is your capital employed. Then we have inventory turnover. Okay, so what is the inventory turnover? Inventory turnover ratio helps the organization to find out the inventory which company needed. And how they do calculate this? Cost of goods sold. This cost of goods sold is divided with average inventory. Okay, average inventory, this is cost of goods sold to the stock. So this is your average inventory. Okay, so this is, you can easily match the cost, the inventory turnover, cost of goods sold to, that means you have to divide with, to average stock. That is, this is the way you can calculate your average inventory. Then gross cash flow. To calculate the gross cash flow, this gross cash flow is what it's typically indicate operating profit. Okay, actually how much company take inflow and outflow for the organization. This is we have to calculate. Okay, then this is help, this gross inflow typically include the operating profit. Okay, this include operating profit. okay, plus non-cash expenses like your depreciation, okay. So this gross cash flow, it's include your operating income, operating profit, operating profit plus non cash expenses, and this non cash expenses like your depreciation, the organization, okay, this expenses company added, okay. So you can match with the before profit before depreciation and interest and tax, okay. This is gross cash flow, so you can easily match. Option number D will be the right answer for this question, okay, option number D. Then long term objective of financial management, okay. What was the long term objective of the financial management, okay. Actually, first of all, the financial management, this specifically helps to the owner of the company, or is to maximize the owners, or we can say shareholders wealth, isn't it? And which is best, which represented by maximum, if the market value maximum market value of the firm, or we can say firm's common stock, and this is reflect the overall value creation of the shareholder, okay. So here earning risks is minimized, timing for return and market perception, okay. These are the factor, but the long term objective of the financial management is to, option number 1, maximum return on investment, isn't it true? Then maximum market share, then maximum the value of the firm's common stock, or maximum earning per capita. So whenever here the right answer will be option number C, because the long term, when we are talking about the long term, so actually for the long term, companies focus on the common stock, that means equity. This is also called as common stock. So the objective of the financial management in the long term, they give a maximum value of the firm or wealth to the common stock, okay. And these are the return on investment, this is important, but it does not capture for the risk or the long term growth. It's also involve the risk, no, okay. It's not actually involve the risks, it's not no risks, okay. Maximum market share, it's actually maximum market share is a strategic goal, not a financial goal, okay. This is we call strategic goal of the organization, okay. Strategic, this is strategic goal of the organization, okay. Then maximum earning per share, okay. So earning per share, actually this is can be manipulated, earning per share can be manipulated by the organization. It's not does not necessarily reflected to shareholders value, okay. So that's why here the right answer will be option number C will be the right answer for this question, okay. Student, understand? Clear? Okay. Then moving toward the next question. This is C. Now next question, that is treasury bill. Actually this is not, there is a printing mistake, sorry for that. This is not bill, treasury bills, okay. Treasury bills is what? treasury bills is actually which the bill is uh, uh, by the government. Okay, so if this any bill or anything is it's issued by the government, these are the risk free investment. Okay, there is a risks are very little risks is involved. So treasury bills are the government blocked and virtual risk free, making them to the standard for the risk free rate in finance. That's why this is treasury bill you can match with the risk free rate. So option A is matched with the third one. Then beta is nothing but your systematic risk, and those risks are which measure the market risk security compared with the overall market, that is your beta. Okay, so you can match with the fourth one. Okay, so option number C will be the right over here. Then capital budgeting. So as you know that capital budgeting helps to the organization to calculate their net present value, and it also helps to the organization to calculate the internal rate of return. So also it's depend on the discounting future cash flow, and which is rooted in the time value of money. So that's why this involve capital budgeting is involved time value of money. Then as you know that what will be the working capital. So this is not capital working, this is wrong, this is working capital. So as you know that working capital, it's a kind of your operating cycle. Okay, and this is directly tied to the operating cycle, which indicate this operating cycle which indicate your inventory, isn't it? This indicate receivables, payables, turnovers. Okay, so hence here will be the right answer will be option number C. Okay, understand? Okay, moving toward the next question. Yes, so the next question which is in your screen, again the statement wise question is giving to you. You have to match with this. Statement number A, a critical assumption of net operating income approach to valuation is that debt and equity levels remain unchanged. Statement number 2, a firm degree of operating leverage depends primarily upon its level of operating cost. So statement number 1, a critical assumption of net operating income approach, that means NOI, net operating income approach to valuation is that debt and equity level remain unchanged. So this statement is true or not? No, because in NOI approach this is a part of approach. Okay, so this actually this approach assume that the capital structure this capital structure nothing but your debt and equity mix. Okay, so this capital structure is debt and equity, and this is irrelevant to the firm's overall valuation. Not the debt and equity remain unchanged. Okay, so they are say that this is irrelevant, so that's why first statement is wrong. What about the second statement? A firm's degree of operating leverage depend upon primarily upon its level of operating cost. Isn't it true or false? So actually what happened, overall cost, when I am talking about the overall cost, okay, it's depend on the operating cost. Actually overall cost of capital remain constant regardless of its capital structure, and market value is not affected by the leverage. So you understand that where a firm's degree of operating leverage depend on primarily upon its operating cost? No, it's not upon the operating cost. It's depend upon the WACC, overall cost of capital. Okay, so that's why the both the statement, that is option number B, will be the wrong over here. Both the statements are incorrect. Okay, so both the statements are incorrect. Then the next question. Okay, next question. Assertion net income approach to the capital structure implies maximum when the degree of financial leverage is equals to 0. First of all, NI approach to the capital structure implies maximum value of the firm, isn't it? Maximum value of the firm, and when the degree of financial leverage is equal, degree of financial leverage is equals to 1, not equals to 0. So this is wrong statement. Okay, then reason. NI net income approach capital structure implies maximum value of firm when the degree of financial leverage is equals to 1. So this is true statement. Okay, so right answer will be option number A is incorrect and B is correct. So option number D will be the right answer. Give me one more time. NI approach to capital structure implies maximum value of the firm when the degree of financial leverage is equals to, degree of financial leverage implies that increase in more debt no, this is wrong. First is incorrect and option number D is right over here. Okay, so D will be the right answer over here, not option number A. The next question. Pareto analysis, then B, variance of the cash flow, then value of the firm is equals to VE plus DE, equity, value of debt. Value of firm is equals to earning before interest and tax of company is KO. This is not CO, KO, cost of capital. Okay, so understand this. Pareto ratio. This is Pareto analysis we have studied in their inventory, because Pareto analysis is a 80-20 rule we follow. Okay, this 80-20 rule commonly used in inventory management. Okay, so it's classify the item by the importance according to the ABC. Okay, according to the ABC. Okay, then variance of cash flow. So variance of cash flow is what? Miller or model. Okay, so here this is approach is used by for the cash flow. Okay, to manage the cash balance under the uncertainty, isn't it? Now value of the firm and value of the firm and the value of equity and value value of the firm is equals to value of equity and value of debt. This is we study in an approach. Okay, this is we study in NI approach. Then value of the firm is equals to earning before interest and tax and cost of capital. So this is the approach. Okay, this is the overall valuation firm, the part of valuation approach, especially in the net operating income. Okay, so this is that. Okay, understand one more thing, that is value of the firm in NI approach is calculated with the help of value of equity, okay, and plus value of debt, okay. But in NOI approach we calculate the value of the firm with the help of earning before interest and tax, and we compare with the cost of capital, overall KO, cost of capital, okay. So here right answer for this question will be option number D. Okay student, moving toward the next question, and this question will be the last question. Okay, statement number A, a sample form population does not have to share the same characteristics as a population. This is correct, this is incorrect. Okay, statement number 2, the difference between the sample statistics, actually this question from the statistics. Okay, so the difference between the sample statistics and its corresponding population parameters is called as a sampling error. Sampling statistic and corresponding population parameters is called as a sampling error. Yes, this is true. Okay, now understand the one statement, that way I will clear all the statement that will help you. A sample forms population, sample form population does not have the share the same characteristics as a population. This is not true. Actually whatever the sample is taken by the researcher, that sample should be identically share the same characteristics as a population. That's why they are taking the sample as a which indicate the whole population or justify the whole population. Though there can be difference due to the randomness, a sample should be representative of the population. So this is a wrong statement. Actually it's not possible to research the whole population. So that's why they choose this kind of population which indicate they having the similarity, okay, and that is from that population the researcher take a sample, and this sample represent whole population. So the statement number 1 is incorrect. Now the statement number 2, the difference between the sample statistics and its corresponding population, so that is here the sampling error. This is true because there is a little bit I'm taking sample for the calculation for the conclusion, but actually whatever the sample I'm taking, that sample and whatever the population I have, this population having the some kind of difference, a little bit difference, and that difference is called as a sampling error. Okay, so here A statement is incorrect but B is correct, so option number B will be the right answer students. Okay, okay, we have two more question. Okay, let's see it quickly. The classification method in which the upper limit of interval is the same as a lower limit interval, what is it called? Okay, upper limit interval and lower limit interval, it is called as your exclusive method. What is it called? It is called as exclusive method. So these exclusive method, this exclusive method, that is, suppose my upper limit is suppose 10 20, so this is 10 is upper limit and 20 is lower limit. So classification method, when we are studying about the classification method in which upper limit is the same as a lower limit, so there is a difference. Here is you can see this 20 is exclusive, not an inclusive rate, because we are continue with the 20 30, then 30 30 40. So this is, if we follow this kind of range, this is called a exclusive method. Okay, Understand? When we are talking about the inclusive method, so 10, 9 to 19, okay, then sorry, 9 to 19, 10 10 to 19, then 20 to 29, then 30 to 39. This is there, you can see there is an the upper limit, lower limit, upper limit is 19, and the second range lower limit is 20. So this is if you see this kind of range, this is called as inclusive method. Okay, so right answer will be exclusive method, that is option number B. This is last question, student. In the normal distribution, increase spread and decrease in height. It's what does it represent? Actually, in the normal distribution, if the spread is actually the spread is refers to how widely the data points are distributed around the mean, that is a spread net. Okay, if this is my normal distribution and this is my mean, so how widely this data are far from the mean, this is spreadness. And decrease the height, actually this height represent the concentration of data point near to mean. How they are, suppose I reduce the height, so it means that the concentration, that their data is closer to each other. Okay, so this is what. So when we are studying, whenever we increase the standard deviation, the spread of distribution is increases. Okay, suppose I increase the standard deviation, the spreadness is also increases. It means the data points are more spread out and the heights of curve decreases. Because this is happen, data is less concentrated around the mean. Okay, so if the large standard deviation is, it means that more variability spreadness in data, where the smaller standard deviation indicate that there's the data points are closer to mean. Okay, so that's why here the option is given to you. So larger standard deviation, smaller of the variance, larger the value of variance, smaller the value of standard deviation. Suppose if your spreadness is increases and your height is decreases, it actually means that the standard deviation of that particular is having the large value. So here is the option number A will be the right answer. Okay, student, so here A will be the right answer. So thank you so much for watching. Okay, we completed our questions. We are submitting. We'll see you in the next session. Okay, if you like it, please do subscribe and like the video. Okay, take care, bye bye.